So, you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Cattani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcattani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Cattani, and I'm joined today by Cody Payne. Cody Payne is Senior Vice President at Colliers International in Fort Worth, Texas, specializes in selling office and industrial investment properties in the DFW market. Over the past 15 years, Cody has closed more than 600 commercial real estate transactions. Combined with Colliers International platform and Cody's extensive knowledge and expertise of leasing management, market conditions, and business, the Texas office and industrial team provides their clients and investors the opportunity to maximize value while creating a competitive advantage that yields the best results. Cody, welcome to the show.
All right, my man. I like that intro. You knew it off the top of your head. I like that.
Took it straight from your LinkedIn. So
yeah, I appreciate it. Sounds very good.
Straight from the source. Whoever wrote that did very well.
Yeah.
I love it. Well, awesome. I'm excited to talk today. Obviously, two asset classes. Well, one that's just an absolute rocket ship right now, and one that's on its way back in to conversation. But take us back to kind of the beginning here. Were you always in real estate and as a broker, or what were you doing before, and what led you to where you're at now?
So no, before I started real estate 17 years ago, I actually sold cars at a car dealership, local car dealership out here when I got out of high school, because I didn't want to go to college. And then a guy actually hired me at a real estate firm that he had trouble keeping agents, and just worked my way there and for quite a while, and then joined a national firm and created a team. And now we're just, off and doing the best we can and trying to make a lot of changes and different, make a difference out here and pick up as much as we can and show the world what we can do.
Awesome. I love that. I didn't graduate from college. Did you ever go back and go to college?
No. So I did. So the guy that hired me, he made me actually go to college. He said he would hire me, but he said I had to go to night school. And so I did that until I made enough money where I knew he wouldn't fire me. And then I quit. And he was like, all right, just go back later. And I said, okay. And I never finished. So
I love it. Good. I'm glad we can relate to that. I have nothing wrong with people who go to college, right? I know that's what we're supposed to do, but it's always nice when I meet a fellow entrepreneur or someone in the industry that didn't also graduate, because it seems like it's a lot of like former doctors and engineers and all this stuff. Yeah. And I'm like, yeah, that's awesome. Cool. Well, love that. So now you've been with them for about 15 years, sounds like. Ton of transactions. You've seen quite the roller coaster, I guess, lately. So let's jump into it here. We kind of mentioned industrial is going crazy. Talk about why that is and what you're seeing in that asset class.
So, and there's several sectors to the industrial side, right? You've got the big box industrial, which, a lot of the heavy hitters and institution and REITs play in. And then you've got the smaller scale side with the flex, what we call the flex industrial, where it's small bay, incubator space. Some of these complexes have, we did one that had 100 some odd tenants in it, and because they're all occupying 1,000 to 3,000 square feet. And so you've got that sector as well that a lot of the private guys have been hugely active in. I like that sector actually the most, just because of the leasing velocity and the rental growth that those see. But those are doing obviously very, very well, but two very different investment sectors on the industrial side.
Interesting. So that flex version you mentioned, the leasing, just shorter lease terms, so it's a little bit more turnover on the lease.
Yeah. So typically when you have some of these smaller guys, occupying 1,500, 2,000 square feet, they're not doing 10-year leases, and in many cases out here, you really don't want them to. And so, especially with the rent growth on those over the past several years, we've got one project that we actually just sold, and The leases in there were, $8 per square foot gross just a couple years ago, and now they're doing 12 triple net. And so that just shows you the growth that little area has specifically seen. And so I think keeping those guys on shorter terms is key, but also a lot of those businesses aren't going to do tremendously long term anyways.
Interesting. So what are some of the factors that you're seeing that are driving this demand in both the big and small?
Well, I think it's a lot of things, especially out here in Dallas-Fort Worth. I mean, I'm not saying anything that anybody doesn't know, but there's obviously a lot of eyes out here from other states and investors and whatnot all over. And so that is probably one of your number one driving factor. And then you've got the stability and reliability that asset class is offering right now compared to others. And then also along with some of your cross asset buyers that are also looking to get into that. And so there's several projects on the industrial side that we've sold that have gone to people that were prominently in the either retail. Also another big one that we've done is with some multifamily guys that have predominantly done multifamily over the years. They've diversified into the flex and industrial sector.
Wow, fascinating. Yeah, definitely a diversification play there, and kind of following that, A, the yield, and B, that demand that we're starting to see. Obviously, supply chain things, the Amazon effect is, everyone's kind of dubbing it now, so to speak. just from wanting all that, and then Amazon built a bunch and doesn't even need it all. So the other asset class is office, which we were talking offline. Kind of depends where it's at, determining the demand. So what are some of those factors that you're seeing that are kind of bringing it back into the conversation?
So, the office sector, I think was hit pretty good from an investor outlook and investor standpoint when COVID hit, just kind of like hotels were. Hotels, look like they bounced back pretty well. The office sector is really going to be area and building specific, right? A lot of this, mid-rise Class B office space in suburban markets that are maybe not in a downtown sector, those are still very much highly sought after. We've done quite a few of those since COVID, and we're actually in the process of listing 4 more for several other sellers right now. And so we've already got good activity on several of those, and I think we'll get those taken care of. The ones that I see have had a little bit of hit, and that's what you and I were talking about, is kind of the ones in the downtown markets or in some of the oversaturated markets where they offer pretty much the same kind of office product really closely together. And when you have that and you don't have as much new tenant coming into that small area, then you're just battling over existing tenants. And whenever you do that, that's when you usually see rental rates kind of get stagnant or stale, or even certain concessions being offered to where they weren't before. But like I said, the suburban Class B market, I'm a big fan of. We've seen a lot of good things happening in that sector. It's just gotta be area specific and building type specific.
Yeah, it makes perfect sense. That kind of suburban play is starting to be huge, as people kind of leave the downtown area, head out there, being closer to work, different factors like that. So what kind of determines whether or not you guys will take on a deal?
Well, so, obviously it has to make sense. We've been in business for a long time, and, we specialize in a specific type of product. We're not generalists, so you won't see us selling multifamily or retail or anything of that nature. And so, I believe we know what we're doing. I've got a good group of guys here. And so if the deal makes sense and, we believe we can execute and have a happy seller and a happy buyer and everybody, it kind of makes sense. But, we still get those as the market continues to shift like it is now with interest rates rising. You still have a lot of this, and this, where you have people still thinking of values a year ago, but the interest rate environment has very much changed. And so, if they're not willing to get on board with the change, then sometimes that's a conversation that we have to have. And so it's kind of deal by deal specific, but as interest rates change and as the market changes and as leases expire and tenants either downsize, expand, or not renew for as long, all these are factors that we have to put into the evaluations.
And what does that process look like for you guys in terms of evaluating and talking to the sellers and potentially having to, kind of bring them back down to earth and some of that stuff?
Well, and one of the hardest things early on, especially with COVID, was if we had to bring something down in price, is finding correct data, to do that. And so that's always the best thing to do whenever you're dealing with a seller or buyer or anybody, and you're trying to, show them what actual market value is to show actual stats and data and how you came to that conclusion. And so when COVID was early on and, you had a great 2018 and 19 and people were like, oh, well, this was selling back then. It's like, well, it's maybe a little different now. But like I said, I mean, there's still some office that we've sold that, has done very, very well and has sold for more than what it would have then. It just is very specific. But at the end of the day, whenever you're doing any evaluation, it's having the right backup data because, everybody's going to require that, from lenders to buyers to appraisers, everybody.
Yeah, absolutely. Couldn't agree more. And so kind of talk about some of those relationships. What makes a good relationship for you guys in terms of, you're obviously the broker, but, on both sides, what are the keys to kind of maintaining good relationships with sellers and buyers and all of that?
Well, and I'll tell you one thing that's happening now that was big back in 2009 and 10 is knowing which lenders to go to, right? And so we've actually picked up several deals that were listed by other firms recently because they didn't have issues finding buyers. They had issues getting a loan and getting, that process completed. And so not every deal, not every lender is universal for a deal. Everybody knows that. And especially in the office sector, I mean, there's a lot of lenders that won't really look at office. And so finding some of these local lenders that are hungry and eager. We've got several credit unions out here that we've done a lot of business with on the office sector. And so having that in our pocket to assist with any buyer or seller, whether they're buying it and financing it or refinancing it, all those are key. And we had a guy that was calling us to sell a deal because he couldn't get it financed, and we said, hey, instead of selling it for taking a slight loss, why don't you just refi it? And so we got him a lender that can do that. And so having those contacts, knowing the hot buttons and cold buttons for these lenders and appraisers is obviously key. And I think that's a big thing that we bring to the table. And also we've got several guys. One of our guys actually just walked in, a leasing agent that a good leasing agent that can also talk about the market and how to improve a building, and is also key.
You mentioned in the earlier how the leases for the kind of the smaller, what did you call them, the smaller industrial?
So you're talking about the flex side?
Flex, that was the term. Are you seeing any changes in office as well, or anything different in terms of the leases?
So, the thing with office space, and especially when you deal with some of this larger office space, is their leases are, very much staggered, right? I mean, you got some folks that you can go anywhere from a year to 50, to 10 years to 12 years. Some can do 15. And so it can take time for some of those leases to expire, which I think, even if you do have a dip in the market on the office space, having that many leases in the marketplace helps, because obviously they don't all expire at once. Is where the flex side, we're working on a deal right now that's a multi-tenant flex, and everybody's on a 1-year lease. So you could technically, worst come to worst, you could have a completely vacant building, but it's no different than an apartment complex, right? None of those guys are signing 5 and 10-year leases on apartments, and a lot of those guys don't want them to. But on the office sector, because finish out is so high, commissions, TIs, everything, time on market is much different than any other sector. The longer lease, the better.
Yeah, that makes perfect sense, especially with the TI and obviously, depending on the tenant as well. You bring in like a bank, that's very specific, right? And so that's going to be something that gym can't, right? A lot of changes to bring a gym into that space later. So,
and I feel the office sector, they like a lot more stable, predictable cash flow. I mean, obviously everybody loves value add, but they really like that predictable factor, which is very, very key, especially with leases that, you got a building with, 15, 20 tenants in there, and you got leases rolling over the next 10 years. You don't have a lot of work every year. You've got it kind of spread out over time.
Yeah, absolutely. And with kind of along that is, and with the increase in inflation, are you seeing, different terms in these leases now to kind of combat that increase in inflation?
Well, and yes, I have. That's also, going to be building an area specific. I've seen TIs are through the roof right now, especially on the office sector. Office is very expensive to operate and to finish out, and so the TIs are very high. I mean, we've been seeing them, $20 to $50 per square foot, and so anytime you have that, you got to factor that into your lease, how much you can get away with amortizing, how long of a lease you can get. And so what you've got these owners of office buildings battling is you're battling tenants that need this finish out. And some of these tenants don't want to do these longer leases. Landlords obviously want as long as possible so that they're not having to front load all this, finish out costs up front. But you see a lot more negotiating, I believe, going on right now. But there's a lot of good movement out here. There's still a lot of leases being done. There's always leases expiring, even if you have tenants, like they were 12 years ago, downsizing. I mean, if you're in a Class B building and you're able to pick up tenants coming down from, Class A, from 20,000 down to 10,000 square feet, I mean, you're going to benefit. And so that's why I always say understanding the building and the tenant size in that specific area, because every market out here is different on the tenant size. And so you've got, Las Colinas, which, is averaging, I think around 3,500 square feet on the tenant size. And then you've got, Plano and some of these other areas that are much larger.
Interesting. Okay. Yeah. I mean, that makes perfect sense, right? So really a very deal by deal basis, even within a market as well, like you mentioned. So kind of break down, I guess, for the listeners, what an office lease contract is broken up into, and what it looks like in the terms and how they're typically structured.
So, if you take just take like a 5,000 square foot tenant that comes in and gets, $20, $25 a foot and finish out, what you'll typically see in many office spaces is where, I mean, obviously there's a lot of different types of leases. You've got gross, you got full service gross, modified, net, double net, triple net. A lot of the ones out here are charging plus electric with a base year. And what that base year does is it's essentially a way for an owner to recollect operating expenses moving forward on that tenant's lease term. And so by setting it at the year that they come in, if those operating expenses go up year over year, they've got an ability to recollect a portion of that from that tenant, depending on how much space they occupy. But as far as everything else in the lease contract, I think what you'll typically see is 25 cent to 50 cent per square foot annual rent bumps on those. If you don't have any crazy TI, some of those can be turnkey finish and not amortized into the lease. And then, if you've got a little more finish out than what a landlord allowed for, you'll sometimes see that amortized throughout their term in their lease. And so, that's obviously going to be very tenant specific and landlord specific. And actually, if you're a landlord, you can use that to your advantage. We're selling a building right now, and they did a deal where they did a $50 per square foot TI, which, they never would have done. But the reason they did it was because it boosted the NOI of the building on the sale. So they're not going to make the money on the lease. They'll make the money on the sale.
Interesting. Okay. But the buyer will then inherit that lease and everything. So why so many different types of leases in office space as compared to some of the other asset classes?
I think it's just because of the complexity of office, right? You got to keep in mind, when you compare it to, say, self-storage or multifamily. I mean, a lot of apartment complexes, I mean, they usually have 1 to 3, maybe 4 different floor plans, right? And it's the exact same throughout. You don't have the exact same floor plan throughout an office building for each office tenant. That's the biggest thing. It's because every office tenant is unique to itself, right? Like our space here is open. We have an open concept. All the guys are, walking around. We can see and hear each other. And then you go to our Dallas office and they've got a little bit of open, more closed off offices. And then you've got some that are all individual offices. And so it's business specific, and that's why it's expensive.
Absolutely. Yeah, makes perfect sense. And so are you guys in a downtown location?
So we're our Dallas office is our Fort Worth office is just south of downtown, but literally right across the freeway.
And then do you guys have a portfolio? Do you take on any of these deals yourselves?
So I've invested in office over the years. I used to actually lease office buildings for a long time, and so that's why I did that. I've also invested in self-storage facilities as well. I'm a big fan of that. I built a facility west of Fort Worth, and had a lot of success with that, and actually recently sold it. And me and the guys are looking at pulling some money together to do a flex business park as well at some point this year.
Awesome. Love that. Yeah, you're right in the heart of it. I'm a huge self-storage guy. I'm in Salt Lake developing one out here as well. So it's a nice asset class and kind of skates under the radar compared to these other big sexy ones.
I love the storage side. I don't know if you've looked much into it. We've got a guy here that does self-storage, and there's a lot of unique opportunities in that sector, also due to financing, because of being able to get like an SBA loan on it, so you can get into some of those with substantial amount less down payment than if you were buying an office or industrial building. But also the rental growth on the storage side is huge. And out here, I mean, it's just storage facilities being built left and right and everywhere else, and that's why cities have so much restrictions and constraint on these guys, because if they didn't, you'd have a storage facility every 10 feet out here.
You'd be at a negative square foot per person. Just so much, just oversaturated. I love it. Well, appreciate all the insight and all of this. We'll kind of wind it down here as we come up against time. But I've got 5 questions I ask all of my guests. It's okay. The final 5. So first question, what's the best advice you've gotten from a mentor?
Best advice I've got from a mentor is use your personality and be yourself to get business. Don't be someone else. Don't be what corporate wants. Be yourself.
I love that. That's great.
Yeah, what is it? It's very hard to do that in the corporate world too, in some aspects. But people like and how like sometimes even when you're buying a car, if you run into one car salesman that's genuine, you're like, man, these car salesmen get bad raps from all these other guys. But I think being yourself will also allow you to have a lot more fun.
Couldn't agree more. I love it. What is it about your career that makes you feel like you're fulfilling your why?
I work with a lot of really good guys here on our team, and they're very supportive, and we have a lot of fun together. And so I think what we do for each other, and how we all have a lot of the same goals to get to a certain point in our careers and to do certain things, I think has been, the biggest key to a lot of that.
That's great. I like that. Favorite non-real estate or investment related book?
Grant Cardone's 10X.
Nice. I started my year with that book. So it's such a motivating book.
I mean, basically, to sum it down, it's anything you're doing in your life times it by 10.
Yep. Or any goal you set for yourself, anything. I love it.
Yeah.
Which is true, right? They say, for me, it's mostly capital raising, and they say if you can raise $1 million and you can raise $10 million, so if you could have any superpower, what would it be?
I'd like to fly because I hate flying.
Really?
Yeah.
What is it, like the turbulence or confined space?
Just being up there, not in control, hoping the guy up front did finish school.
Yeah. I had a pilot on. He's a business coach, but he said, he's like, yeah, pilots make mistakes sometimes. And I'm like, please don't tell me that.
They're supposed to be perfect.
Absolutely. Cool. Last one. What's the best way for people to get a hold of you and reach out if they want to learn more?
Best way to get a hold of us is texasofficeinvestments.com. I'm also very active on LinkedIn. That keeps me up at night. And so, find Cody Payne on there and we'll chat and have a good time and talk about real estate, cars, whatever it is.
I love it. Cody, thanks so much for all of your time and insight. Really appreciate it.
Thank you, sir.
Absolutely. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.